Building upon the basics, let's delve into the types of patterns to look for when day trading. These patterns can provide clues about future price movements. One common pattern is the engulfing pattern. This occurs when a small bar is followed by a larger bar that completely engulfs it. A bullish engulfing pattern, where a green bar engulfs a red bar, suggests a potential upward trend. Conversely, a bearish engulfing pattern, with a red bar engulfing a green bar, indicates a possible downtrend. Another important pattern is the hammer or hanging man. These patterns have small bodies and long lower shadows. A hammer appears in a downtrend and signals a potential reversal upwards. The hanging man occurs in an uptrend and suggests a possible reversal downwards. These patterns are more reliable when confirmed by subsequent price action. The doji is another pattern to watch for. It forms when the opening and closing prices are virtually the same. Dojis indicate indecision in the market and can signal potential trend reversals. A spinning top is similar to a doji, but with a slightly larger body. It also suggests indecision and potential changes in direction. Gaps are also significant. A gap occurs when the price jumps from one level to another without any trading in between. Gaps can act as support or resistance levels. Breakaway gaps signal the start of a new trend. Runaway gaps occur in the middle of a trend. Exhaustion gaps signal the end of a trend. Triangles are also common chart patterns. Ascending triangles are bullish, with a flat top and rising bottom. Descending triangles are bearish, with a flat bottom and falling top. Symmetrical triangles are neutral, with converging trend lines. These patterns often precede breakouts in the direction of the triangle's bias. Head and shoulders patterns are reversal patterns. The pattern consists of a peak, left shoulder, a higher peak, head, and another peak, right shoulder. The neckline connects the lows between the shoulders. A break below the neckline signals a potential downtrend. Inverse head and shoulders is the opposite, signaling a potential uptrend. Double tops and double bottoms are also reversal patterns. A double top occurs when the price attempts to break a resistance level twice but fails. This suggests a potential downtrend. A double bottom occurs when the price attempts to break a support level twice but fails. This suggests a potential uptrend. Flags and pennants are short-term continuation patterns. Flags are small rectangles that slope against the prevailing trend. Pennants are small triangles that converge in the direction of the trend. This pattern suggests a temporary pause before the trend continues. Remember that no pattern is foolproof. Always use other indicators and analysis techniques to confirm your trading decisions. Volume is a crucial factor to consider. High volume during a breakout or reversal increases the likelihood of the pattern's success. Low volume may indicate a false signal. Moving averages can help identify trends and potential support, resistance levels. The Relative Strength Index, RSI, measures the speed and change of price movements. It can help identify overbought or oversold conditions. The Moving Average Convergence Divergence, MACD, is a trend-following momentum indicator. It can help identify potential buy and sell signals. Fibonacci retracement levels can help identify potential support and resistance levels. These levels are based on the Fibonacci sequence. Combining different patterns and indicators can increase the accuracy of your analysis. Practice is key to mastering bar chart analysis. Use a demo account to test your strategies before risking real money. Stay disciplined and stick to your trading plan. Manage your risk effectively by using stop-loss orders. Continuously learn and adapt to changing market conditions. Successful day trading requires patience, skill, and a deep understanding of market dynamics. With a solid foundation in bar chart interpretation, day traders can now delve into specific patterns. Several bar chart patterns are particularly useful for day traders. Let's explore some of these key patterns and how they can inform trading decisions. Bullish engulfing patterns, where a large up bar completely covers the previous down bar, suggest a potential upward trend. This indicates strong buying pressure overcoming previous selling. Traders often see this as a signal to enter a long position. Conversely, bearish engulfing patterns signal a possible downward trend. Here, a large down bar engulfs the preceding up bar. This suggests strong selling pressure and a potential short opportunity. Other patterns, such as hammers and shooting stars, indicate potential reversals in price direction. A hammer, with its small body and long lower shadow, suggests that buyers stepped in to push the price up after a decline. A shooting star, conversely, has a small body and a long upper shadow, indicating that sellers push the price down after an advance. Recognizing these patterns requires practice and careful observation. It's not enough to simply identify the shapes. You must understand the story they tell about market sentiment. It's also essential to consider the context in which these patterns appear. The surrounding price action can significantly influence a pattern's reliability. A bullish engulfing pattern after a prolonged downtrend is more significant than one occurring during a period of sideways trading. This is because it signals a more decisive shift in market momentum. Similarly, a bearish engulfing pattern after a sustained uptrend carries more weight. Volume is another crucial factor to consider. High volume during the formation of a pattern strengthens its signal. For example, a bullish engulfing pattern with high volume suggests strong conviction among buyers. Conversely, low volume may indicate a weaker signal and a higher risk of failure. Furthermore, consider the time frame of the bar chart. Patterns on longer time frames, such as daily or weekly charts, tend to be more reliable than those on shorter time frames, like 1 minute or 5 minute charts. This is because longer time frames filter out more of the noise and volatility. Day traders often use a combination of different time frames to confirm signals. For instance, they might look for a bullish engulfing pattern on a 15-minute chart and then confirm it with a similar pattern on a 5-minute chart. Combining bar chart analysis with other technical indicators can further enhance trading accuracy. Indicators like moving averages, RSI, and MACD can provide additional confirmation. For example, if a bullish engulfing pattern occurs near a moving average support level, it strengthens the case for a potential long trade. Similarly, if the RSI is oversold when a hammer pattern appears, it suggests a higher probability of a price reversal. Mastering bar chart patterns takes time and dedication. Start by focusing on a few key patterns and practicing their identification on historical charts. Then, gradually incorporate them into your live trading strategy. Remember to always manage your risk and use stop-loss orders to protect your capital. By combining bar chart analysis with other technical tools and sound risk management, day traders can significantly improve their chances of success. The key is consistent practice and a disciplined approach to trading. With experience, you'll develop an intuition for these patterns and be able to make more informed trading decisions. So, keep studying, keep practicing, and keep refining your skills. The rewards of mastering bar chart analysis can be substantial. Happy trading. Remember, every chart tells a story. Learn to read it well, and may your trades be ever in your favor. Good luck. Now go and conquer the markets. The world of day trading awaits. Embrace the challenge, and may your profits soar.